Good afternoon. This is Kendall Storch from Gallagher Benefit Services. I wanted first to thank everybody for taking a little bit of time to listen in on the presentation today. We're going to get started in literally about 15 seconds, but a couple of housekeeping orders. As you can imagine, we will be recording this presentation, so we will be posting this out on the 3DS HR site if for some reason you need to hop off or you want to listen to this again at some later date. The presentation will be out there with the audio. I'm going to move along to our agenda slide and we'll get started here, but essentially these are the different topics I'm looking to cover today. We'll talk about the markets for the first 9 months of the year, so through the end of third quarter. And I'll share kind of our viewpoints on what's been happening with the markets, and we'll touch on a few different specific topics around perhaps where the markets might be headed. We'll take a look at the performance on the funds within the DS plan itself and kind of highlight overall how has performance been, maybe make some comments on anything that hasn't been quite as strong. And then finally, the meat of the presentation really is around this concept of what I'm calling downshifting your portfolio. So certainly the market has come up quite a lot. The market is at record highs. We continue to reach record highs day after day. So with that as a backdrop, it might be interesting to raise a few questions about how you might want to try and manage your portfolio in that environment. So I'll walk through a series of different slides on that topic. And then we'll open it up for some questions. My goal here is to try and have this completed with Q&A within an hour. So we don't want to take too much of everybody's time, but that's effectively the timeline for today. So let's get started and we'll talk a little bit about the markets. So high level, a couple of things to keep in mind. So what's been happening with the markets? Clearly, we've had excellent returns so far this year. Last I looked, S&P was up around 16% year to date. So double-digit returns for 2017. I guess the question is, what has caused the market to come up in this fashion? So we got a number of different factors that are at play here. I think to some degree, it's a combination of expansion, so globalized expansion, not only just here in the United States, but actually kind of across the world, coupled with very calm or restrained monetary policy, or in other words, very low inflation. So if we have growth happening, not just in the US, but also abroad, and we have an environment that is receptive and is looking to enforce that growth, that puts us in a situation or in a position where the markets might respond well to that. So as we talk about kind of the outlook here, and I'll make some points along these lines as we go along, as we see right now, pretty low recession risk as it stands right now when we look at some of the fundamental factors that are out there, and I'll touch on some of those. The U.S. economy, as we look at it, still very healthy. U.S. economy is chugging along very well, but as we look at kind of where we stand in the economic cycle, we're probably getting a little bit longer in the tooth. So typical business expansion, typical business cycle is about 7 years. Right now, we're into our 9th year of expansion. So the business cycle is kind of stretched out. I'll make a couple comments about why that might be. There's another thing that's kind of floating out there as we shift the conversation towards maybe what the Fed is thinking and what's happening with interest rates, and how maybe the Fed and its actions in terms of trying to change what it's been doing up until this point, how that might impact the market. So we'll talk a little bit about that as well. So I think before I move on to the next slide, I think the key thing here is that I would underline is this synchronized global expansion. That's definitely a hot topic or a buzz term right now, where it's relatively unusual for kind of all the major markets, whether that's US, whether that's international, or whether that's emerging markets, to all be expanding at the same time. So we've got this sort of Goldilocks environment. And that, I think, is what's helping kind of stoke the fires on keeping the markets moving forward. Okay, so let's take a look at some of the numbers. So I have here numbers for just third quarter, as well as year to date, for a variety of different types of investments. So you can see the big winner so far this year has been emerging market stocks, up 28% year to date, and up 8% just third quarter alone. As you kind of scroll down the list here, one of the little themes that you might note is where international stocks fall in relative to domestic stocks. So we're in the third quarter right now, or third consecutive quarter, where international stocks have done better than US domestic stocks. So hence the reason why emerging markets, non-US small cap stocks, non-US developed country stocks, those are three of the four top performers for the quarter. And I'm going to call it three of the four top performers year to date as well. So we'll talk a little bit more about what's been happening on the international front. But again, as you scroll down the list, one of the other things that you might note is not a lot of negative signs for the quarter. Basically, everything that we are looking at here was in positive territory. Even when you look on a year-to-date basis, basically everything is in positive territory with the exception of commodities. So when we look at some of the sector returns and specific slices of the economy, there's only really been a couple right now that really haven't kept up or haven't participated so much in 2017. Okay, why don't we do that right now? So what I might draw your attention to is the upper right-hand graphic, where we're looking at different slices of the US economy. The blue line is the third quarter result. The green line is the year-to-date result. So one of the things I think you'll note, year-to-date, there's only two sectors that have negative returns. That would be energy and telecom. Energy primarily due to the fact that oil prices have been kind of sliding so far this year. So oil prices came up last year. They've taken a turn going the other direction. So with energy, much of that is driven by where oil prices are. The falling oil price is going to have a negative impact on the energy sector. Telecom, I think, has negative returns ultimately because telecom sector grew substantially last year. And probably the previous 2 years beyond that. A lot of that is because people have been using telecom stocks as a proxy for bonds. So if you buy AT&T, if you buy Verizon, some of these kind of names, they tend to have a very large dividend that they pay. So as we'll see in a little bit, where bonds haven't been paying very much, people have been using stocks or certain types of stocks as sort of a replacement for bonds. Telecom kind of fell into that category. So as the stock market has come up, I think the demand for telecom has come down a little bit, as well as the valuations there have come up a lot as well. One of the kind of big note here, as we look at top performers, much of the story this year has really been with technology. So as you can see, year to date, the tech sector is up 27.4%. So tech is a big driver to where the returns are so far in 2017. If we go back to 2016, tech really didn't do that much. Tech was one of the laggards, I guess you could say, relative to some of these other sectors. So it's sort of like tech has just kind of hit its stride in 2017, and as a result, that segment of the economy has really exploded. So some really good numbers there. If you scroll to the lower left-hand column again, or graphic, I guess you could say, again, these are some of the numbers on the international front. Pretty impressive kind of across the board, especially on those year-to-date figures. So whether you're looking at emerging markets, Latin America, emerging Asia, big numbers there. Even if you're looking at developed countries, So that would be Europe, Japan, Canada. We've also got solid numbers there as well. So it's nice to see international markets kind of coming back around. Last but not least, if we look at the fixed income side of things, so if we look at bonds, not really a lot happening with bonds right now. Interest rates have been relatively flat so far this year. We've had a few raises from the Fed, but since January, rates haven't moved really all that much. So there hasn't necessarily been kind of a lot happening on the fixed income side. You can see the better performers this year tend to be the riskier types of bonds. So that would be emerging market debt, high yield bonds, or bonds that have very long maturity. So the riskier the type of bond, we've ended up with better returns as a result of that. The safer the bond, so some of the different bond types to the right on this chart, not a lot of return there. Okay, so moving on, one of the other sort of unusual things that's been happening has been, we've had this extremely solid rise in the stock market itself, but that's also been coupled with very low volatility. So as you can kind of see with each of these different types of asset classes, even though the markets have been going up, the amount of volatility with each of these asset classes has actually been shrinking. So in historical terms, this is, again, relatively unusual. Generally, we'll see a little bit, particularly with the market going up, we'll see more volatility there. We'll have more periods of time where the market takes a breather or steps back. You haven't really seen so much of that with the latest expansion. So this again kind of underscores this kind of Goldilocks environment where we have solid corporate earnings, we've got low volatility, we've got low interest rates, we've got low unemployment, we've got an accommodative Fed, etc. We've got expansion abroad as well. All of those kind of factors are coming together and giving us this kind of outlook. Okay. So let's talk a little bit about where we are in the economic cycle. So as you can kind of see here, not only here in the US, but also abroad, basically all these different countries are still in the expansionary phase. If we had looked at this a year ago, what I think we would have noticed is that the blue circle for China would have been further to the left. So China was later on, I guess you could say, in economic expansion back in 2015 and 16 as China was kind of struggling. But China has picked up pretty dramatically here in 2017. So basically all these different countries are not in recession, are still in expansion. I think the other piece of it, though, is sort of where these different countries are on the chart. And you'll note the U.S. Is tending to be more towards the right of the chart. So this is of the chart. So this is what I was talking about in terms of the U.S. expansion has been happening for 9+ years, still going, but starting to look a little bit older, longer in the tooth. We're heading more towards perhaps a situation where the economy may slow some more as time goes on. Okay. I wanted to touch on this as well. So I had mentioned this concept of this synchronized global expansion. Relatively unusual to have all these countries growing basically at the same time. What has kind of promoted that? A lot of it ultimately has been China. So we come back to China, the world's second largest economy. As I was mentioning before, back in 2015, 2016, China was struggling, where the economy there was not growing at its historical rates. They had all sorts of issues with kind of how they were looking to try and make the economy move forward. So if you look at the dark blue line, I guess you could say that's how much importing China had done. You can see that kind of flattened out between 2015 and sort of midway through 2016. But from that point forward, imports for China have grown dramatically. And you can see the sharp spike at the beginning of 2017. But what that's done is that's raised export orders for all these other countries. So you can see the amount of demand that China is creating for exports. That's benefiting kind of everybody else. So the fact that China has kind of moved from sort of a semi-recessionary period again back into expansion, it has sort of a domino effect across all the other countries in the world. So this is also a factor in terms of what's causing the markets to continue to rise. All right. So rising markets is probably a topic that's on a lot of people's minds, something I'll be talking about a little bit further on in the presentation, but I hear a lot of people talking about valuation as it stands right now. So there is no question, as we sit here today, if we look at what the US stock market is trading at, how expensive the US stock market is, if we compare that to long-term averages, the US stock market looks kind of expensive right now in historical terms. And you can kind of see that with the green line. The green line is the US market. The green dotted line has been its historical P ratio. So US market appears to be on the more expensive end. Sort of the follow-up question with that is, okay, is that sustainable? Can we continue to creep along at this rate and not have the US market come down and move back towards historical norms? So a couple of thoughts along those lines. One of the people that I listen to, I think, is a good take on the economy is a fellow named Dr. David Kelly. He's the chief economist at JP Morgan. So I was listening to his take on the markets this last quarter, and thought he did a good job of characterizing what the U.S. economy looks like. He called it a healthy tortoise. So the U.S. economy has been kind of grinding forward since 2008 at these, relatively low growth rates. We've been growing at, 1.5%, 2% GDP since really the Great Recession. But what he was saying is, even though we're not growing super fast, so to speak, the rate of growth is one that's sustainable. We can continue to move ahead at roughly a 2% GDP rate without kind of upsetting the apple cart, not creating a ton of inflation, not creating a ton of wage growth, etc. So a steady growth rate would sort of seem like something that perhaps the U.S. economy could continue doing. The second piece that he was talking about is, I mentioned before, the U.S. The typical business cycle is about every 7 years. We're 9 years into the business cycle right now, or the expansionary period, which is long. So Dr. Kelly's thought on it really was, with all the sort of financial engineering that the federal government had to do after 2008 by keeping interest rates very, very low, what that's done is it's stretched out the normal business cycle. So what normally would happen in 7 years may take 12 or 14 years because we've done historic things with monetary policy to try and keep the economy alive. So that was another kind of point that he brought up in terms of why expansion could perhaps continue to extend. When we look at some of the fundamental factors out there, whether that's corporate earnings continue to be extremely strong, record corporate earnings again in third quarter, whether that's inflation is ticking up a little bit but still very, very low, whether that's interest rates are also extremely low, whether that's unemployment, the unemployment number is way down. I'll give you a little statistic about this, but in August of 2009, there was 6.4 people out of work for every available job. If we look at where things are as of August of 2017, there's only 1.2 people out of work for every available job. So the pool of workers who are out of work, quite frankly, has shrunk substantially since 2008. So, these, for what it's worth, these are all good things. As more people are back to work, if they're earning a paycheck, they'll spend that money, and 70% of the growth of the U.S. economy is a function of the consumer. So if the consumer has more money in their hands, that's probably a good thing. Okay. If we look at valuations again, and I'm not sure if you'll necessarily be able to see it here on this slide, but it does seem to come through on the print version of it. But we have all these different countries here. You'll note a couple of blue diamonds. There's a series of other blue diamonds here, sloping upward from Russia all the way in the left-hand corner. If you kind of drew a line connecting these different blue diamonds, that's basically where these different countries are in terms of, again, valuation. I think the takeaway from this is the US blue diamond is the highest one. And as you move to the left and scroll down, the valuation numbers come down. So the point here really is, although the US economy has done extremely well and the US stock market has done very well, there are other countries around the world where their stock markets haven't risen nearly as fast, and where their multiples don't look nearly as high. So it's interesting, as I mentioned before, this is the third consecutive quarter where international markets have done better than US markets. It would seem that there is a bit of a shift in outlook where you can imagine large institutional investors who may have billions and billions of dollars that they need to invest. They're looking at kind of where things are here in the US and what they have to spend to buy some of these companies. If you look at some other very good companies abroad, you can buy them much more cheaply. So there is a value argument to be made as you look outside of US borders. Okay. So it's not purely a valuation story, I guess you could say. So, sometimes companies are cheap for a reason. They're not in good shape, etc. But what this is showing us is, as you look at earnings growth, so how much companies are actually making or what their profits look like, you'll note the rate of increase for emerging markets and the rate of increase for developed markets, the orange and the green line. If you look at the slope there, it's substantially steeper than where the US is. So along the same lines of kind of, interesting what's happening abroad, it's not necessarily that these countries or these stocks look cheap. It's also coupled with these countries are expanding, and the companies within these countries are actually posting solid earnings. So the two of those kind of factors, things look a little bit less expensive to buy stocks abroad, plus companies in Europe, Japan, Australia, Canada, the emerging markets, they seem to be doing better. Their corporate earnings are growing faster maybe than what's happening in the US. Okay. One of the other things that I mentioned earlier on was around, what might be some things that we should be looking for that could upset the apple cart to some degree. So one thing that we've noted or we've highlighted is the fact that the Federal Reserve is trying to change its tactics as we stand here today. So, the Fed would like to see a little bit more inflation. They don't want a lot of inflation, but they would like to see a little bit more inflation. And if they get that, that allows them to be able to raise interest rates here in the United States. So economic recovery is still, it's a delicate situation. So they don't want to suddenly raise interest rates substantially all at once. So the Fed is looking at ways where maybe they can do some other things to help interest rates go up without having to necessarily adjust rates. So one of the things that they can do is the Fed has been buying bonds since 2008 as a way to kind of artificially lower interest rates. So what the Fed has announced is that they're going to stop their bond buying, and as it says, a balance sheet of about $4.5 trillion worth of bonds. So they're going to stop adding to that. Their intention, as it stands right now, is essentially they'll let those bonds just kind of mature, rather than trying to dump those bonds onto the market and try and sell them, which could have a negative impact. But we just don't know kind of what's going to happen as the Fed stops buying bonds. Because as I mentioned before, the Fed has done unusual things since 2008 to try and fan the flames on the economy. The biggest thing has been to artificially keep interest rates low. So it's unclear at this stage what will happen when the Fed kind of takes their foot off the accelerator and stops sort of supporting bond buying. So that's something that we're kind of keeping an eye on as maybe a factor, an unanticipated factor, an unexpected factor that could perhaps surprise the market. Okay. A little bit on bonds themselves. So I think that the point of this slide really is that there's not a lot of yield out there. Bonds are not earning a lot of money, quite frankly. I'll give you kind of an interesting statistic around that. But as it stands right now, if you look at kind of all the bonds in the world that are investment grade, less than 5% of those bonds have a yield of more than 4%. So 95% of the bonds out there are yielding less than 4% interest. If we go back to 2008, or pre-2008, and we look at the same thing, investment grade bonds around of the investment grade bonds back in 2008 were yielding more than 4%. So we've gone from a situation where 80% of the high quality bonds out there were pumping out a 4% interest rate to a situation where only 5% of the bonds out there are pumping out more than 4%. So I think that's a pretty good stat around kind of what's been happening with bonds. Everything that the Fed has been doing to keep interest rates down has ultimately been working. And as a result, there's not a lot of yield to be had in the bond world. So if you're looking for yield, if you're a retiree, if you're looking for income, it almost kind of forces your hands to go to some of the riskier side of the bond world. So emerging markets, high yield corporate bonds, long maturity bonds, those tend to be the types of bonds that have a little bit more volatility in them. And those are the ones that are yielding a higher rate of return or a higher interest rate. So the bond situation is not a lot to be had there, so to speak. And I think that's also probably one of the factors that, again, continues to fuel the stock market. If you have to choose, do I want to buy bonds or do I want to buy stocks? And what's the outlook there? As it stands right now, one could probably make an argument that the outlook for stocks continues to look better than the outlook for bonds. So speaking of outlook, as we kind of look at the things that are kind of helpful for the economy, as we look at the business cycle, so yes, we're getting a little longer in the tooth with the U.S. economy, but that said, there may still be some run room to be had because we've got sort of an unusual business cycle because of 2008. We've got this synchronized global expansion happening. So with very low recession risk, most of the other countries abroad, as we saw, corporate earnings are picking up. Their valuations for their their central banks also want to kind of keep the momentum going, so they don't seem to be doing anything that might put that at risk. That's also a good thing. Upside to global economic momentum may have peaked. So that, I think, maybe more on the U.S. side, perhaps, if the from where we are from a valuation standpoint, how much higher can we potentially go? We can still creep up, but relative to some of the other international markets, they may have a little bit more of a ceiling. Some of the risks that are out there, we talked about the Fed and how they're trying to unwind their bond buying. We're not quite sure what that might do to the economy. It's an unknown. As we saw, China has a big impact on kind of what happens with the global economy, both in a positive and potentially in a negative way. So if China decides to clamp down, I guess you could say, on their own expansion or how their economy is doing by raising interest rates, that might have an impact. The other risk that's always out there is some sort of a geopolitical thing. It's nothing that we can control, but that's probably the biggest risk that people are looking for. But we just never know when something like that might happen. Could add to the risk side. Okay. So I will tie up my my economic commentary there and move on to how all this is playing out for Dassault and for the funds in our retirement plan. So what I have here on this slide, here are all the different funds that we have as part of the Dassault 401k plan. These are the returns through September 30th. I have the year-to-date returns for each of the funds, and then I have the returns for the peer group. So that's my my yardstick for comparison. So if we're looking at a fund that invests in large tech companies, a large growth fund, we're looking at the peer group would be all the other funds that do that same job, and what's the average return there. So I think the takeaway from this slide is, as you look at things here, anything in green would be a fund that's outperforming its peer group. Anything in red would be a fund that's underperforming its peer group. We only have 3 funds year to date that are not beating their peer group, and 2 of the 3 are very much within striking range, whether that's the T. Rowe Price target date fund for the year 2005. So this would ultimately be probably somebody in retirement, just 23 basis points off the peer group there. The U.S. bond index, so as I mentioned before, not a lot happening in the bond world. Probably an environment where maybe some more active management can add some value. Something like that seems to be playing out. And Templeton Foreign, lagging a little bit this year. Templeton is really a deep value manager, so they're looking for really kind of beat up companies, I guess you could say, abroad. They don't have nearly as much a stake in technology names as some of their competitors, so they've lagged a little bit because of that. Outside of that, though, it's a lot of green. Mind you, this is just the first 9 months of the year, so it's a very short period of time that we're looking at. So let's expand out a little bit. So here I have the percentile rankings. Excuse me. Go back here. All right, there we go. I have the percentile rankings for each of the different funds in the plan. Essentially, the way you read this is the smaller the number, the better. So if I take the T. Rowe Price Retirement Balanced on a 1-year basis, it ranks in the top 43rd percentile. So that means it's beating 57% of all the other funds like it. And so top half. As you scroll down the list, I think you'll note, quite a few funds top half or better. And as you scroll to the right to the longer term numbers, the overwhelming majority of our funds are top half or even top quartile. I'd probably draw your attention as well to the target date options. We do have a lot of utilization of the target date funds. T. Rowe Price arguably has been probably the best target date manager out there. As you can see, on a 1, 3, and a 5-year basis, overwhelming majority of these funds are top decile. So a couple of quick summary points on performance. So year to date, all but 3 rank in the top half of their peer group. On a 3-year basis, all but 4 in the top half. On a 5-year, all but 2 are in the top half. For our target dates, as I just mentioned, all but 1 are top decile over the past 5 years. From an expense standpoint, all of our funds rank below average in terms of cost, and more than half the funds that we have are in the cheapest 3rd percentile relative to their peers. So Pretty good story, at least so far in 2017 from a performance standpoint. Okay, so with that as our backdrop, we've talked about the economy, we took a look at some performance on the funds that we've got. How do we take this information and maybe use it in more practical terms? What should I be doing in light of this information? So the rest of the presentation I'm calling downshifting your portfolio. I think it's interesting to put some of this stuff in context and to give ourselves a little bit of framework for the rest of the discussion. But I think this slide does a really good job of capturing that. So where have we come from? So this is the S&P 500 index going back to 1997. Clearly, if we take a look from 2009 forward, the S&P 500 index is up 272% from its bottom. So we're closing in on nearly a 3-time multiple of return since March of 2009. So as you look at this chart and you look at the rise in the market from sort of the depths of 2008, maybe this raises some questions. So here are some questions for people to contemplate for themselves. Number one, have you considered locking in any of your gains? So as we just saw in the previous slide, the stock market's up 272% from its bottom. I would hazard a guess that most people have some gains in their portfolio. They probably made some money. It'd be hard not to make money, quite frankly, since 2009. What have people done to try and capture those gains? You only have a gain on paper from the perspective, even though market's up 272%, if the market went down another 270%, you'd be back to even Steven. So what have people done to try and maybe sweep some of those gains off the table? With that rise in the market, that may also have impacted your risk profile. So if you look at how much money you had ideally in stocks and how much money you ideally had in bonds, maybe you had a 50-50 split, for example. Well, with the run up in the stock market, if you haven't adjusted anything, the stock piece of your portfolio is probably a much bigger number, and the bond piece is probably a much smaller number. So if you now have a lot more stock exposure, you probably have more risk in your portfolio. So the question would be, are you comfortable with that? What could happen if to your portfolio if the market corrects? This may not go on forever. And when the day comes when the markets decide to sell off, how's that going to impact things? And have you positioned your portfolio in a way where you're comfortable with some of the downside element of it? And then finally, how do we actually go about assessing risk? What are some things that we might look at, either from a statistical standpoint or maybe a characteristic of some of the different funds that we own that might give a sense for, is this a riskier type of fund? Is this a more conservative type of fund? And that applies both on the stock side as well as the bond side. So back to my point about this concept of rebalancing. And I used the example previously of someone with a 50-50 split between stocks, bonds, and cash. Here in this example, looking from 1995 to 2015, we start out with a portfolio that's, again, kind of 50-50. If this individual didn't make any sort of adjustments to their portfolio by 2015, instead of being 50-50, they're almost 70-30 stock to bonds. So if they originally picked that 50-50 split with the idea in mind that I want to have kind of half of my portfolio without a ton of downside, you're not in that position as we sit here in 2015 in the example. So you've inadvertently added more risk to your portfolio. So what can that do? If we look at a variety of different types of portfolios, what I would draw your attention to is the downside here. So the worst 5-year returns. So that 50-50 portfolio that I was talking about is basically the balanced portfolio that I have on this list. So the worst 5-year result here was a negative 6.18%. So that was ultimately the downside there. But as I mentioned before, inadvertently, because the amount of money in stocks grew because the market went up, my previous example or my hypothetical person here, they don't have actually the balanced portfolio. They have something closer to the growth portfolio, which is more like 70% stocks and 30% bonds. But note the worst case scenario there. So this person went from an expectation of kind of a worst case being a 6% loss to over a five-year period to a 10% loss year over year over a 5-year period. So that's a pretty big difference. And it's something that ultimately is avoidable. It doesn't necessarily have to be this way. So whether you're aware of this or not, there is the ability on the net benefits website, on the Fidelity website, to be able to code your account to automatically rebalance so that your portfolio doesn't get out of whack because of the market going up or down and not making any sort of adjustments to that. So I have a few screenshots here of kind of where you would go on the website and what you might need to do to set up a rebalancing function on your account. So if you go into your account, this is under step 1 and you're on the summary page, you'll see the little tabs at the top. If you go into investments and then change investments, which is step number 2, we get these, the green box and the 2 blue boxes. If you click on the box that says exchange multiple investments, that's where the rebalancing function exists. So you can go in here, you can code your account to say, okay, I want 50% of my portfolio in stocks and 50% of my portfolio in bonds. And then I can also, under step 4, tell my account to relook at itself on a regular basis. You can say, I want my portfolio to rebalance every quarter, semi-annually, annually. So you can code this to happen automatically, so you don't have to remember to do it. So I think this is a nice feature, particularly in light of kind of where we are right now. If people haven't looked at their portfolio and thought about, does it make sense to rebalance based on kind of where we have come, that might be something to think about. So one of the other things that I mentioned, was about risk and how do we define risk and how do we look for clues, I guess you could say, to get a sense of how much risk might exist with some of the different funds or the investments that we have. So I was going to talk about a couple of terms or statistics that we can look at with respect to the stock funds that we have in the plan. So I might work backwards, but I'm going to guess based on most of the folks at Dassault, people are probably familiar with the concept of standard deviation. And really, this is just sort of the range of movements that's possible for each of the different funds that we might have. So the way that we would look at standard deviation, it's just sort of it doesn't really mean anything unless we have some sort of basis for comparison. So if you look at the standard deviation of our fund and then compare it to perhaps its peer group or compare it to a benchmark index, that will give you an idea of, all right, the range of volatility is higher than normal, the same as normal or average, or less than normal. So we'll look at that in a second for an example. Beta is another one or another statistic that is sort of a quick snapshot way of getting a sense for volatility. So basically, the way you use beta is if we have a fund where with a beta of 1, essentially what that means is that the movements of that fund are pretty much right in line with the movements of its index. So if we had a fund that looks a lot like the S&P 500. Um, the movements of that fund, if we had a beta of 1, would track precisely with the movements of the S&P. Where beta gets interesting is where it's not 1. If we have a beta higher than 1, that's indicating that that fund is more volatile. So in my example, if we have a fund with a beta of 1.2, what it's basically saying is that fund is 20% more volatile. It could go up 20% more than the S&P in a rising market, or it could go down 20% more than the S&P in a falling or in a declining stock market environment. So betas north of 1 indicate more volatility. Betas south of 1 indicate less volatility. So, if we put some of this into practice here and take a look at, a couple of the funds that we have in the plan, I picked our 2 large growth funds, for example. So using kind of some of these measures, if I look at beta here, the Fidelity New Insights has a 3-year beta of 0.89. So quickly, I can kind of use that statistic to say, this particular fund probably takes a little less risk or has a little less volatility than my benchmark index, that Russell 1000 growth. So in a rising market, it may not go up quite as much. In a falling market, it may not fall as far. And we can kind of see some of that in play here. If you look at the bottom of the chart, let's go to 2008, which is a good example, a nice down market. You'll note the Fidelity Advisor New Insights was down. It doesn't sound good, but it was down 37% in 2008. But the peer group, the average large growth fund, was down 42%. So in a falling market, it fell less. A rising market, we can go to 2009. So here we've got the rebound. New Insights was up 29% in 2009, but the peer group was up 42. So I think this is one way that you can kind of get a quick snapshot on how much risk might exist with each of the different funds. Franklin Growth, similar profile, tends to take a little bit less risk. And we can also see that with the range of movement or the range of volatility with that standard deviation number. The standard deviations, at least on a 3-year basis, are less than the peer group and less than the index. So I guess the takeaway here, as we look at large growth, we probably have slightly more conservative large growth funds. Where can I find this information? All this data here, you can find again out on the Fidelity website. If you go into the investments tab and scroll down, you'll see all the different funds. If you click on any of the funds, it will pull up these different fact sheets. The fact sheets contain the beta and contain the standard deviation figures for all the different funds. So that's a place you can look if you want to get more information on any specific funds. So I talked about beta, I talked about standard deviation, at least as it relates to stocks, but that's just kind of one piece of the puzzle. What about on the bond side? How do we assess risk with bonds? So a couple other terms or a couple other statistics that we can look at to get a sense of risk with bonds. So probably the number one stat that people will look at for bonds is around is this concept of duration. So basically, as you look at when you look at the duration statistic, I'll show it to you in a second on the next slide. What this is telling us is if we had a bond with say a 5-year duration, if interest rates rose by 1%, we would expect the value of that bond to decline by 5%. So the duration figure is basically our amount of movement for every 1% increase or decrease in interest rates. I'll echo this one more time. 1% rise in interest rates. If we have a bond with a 5-year duration, we would expect a 5% decline in value, and the opposite going the other direction. If we had a 1% drop in interest rates, we'd expect a 5% rise in value for those bonds. So duration is an important number. You know, we use that a lot to try and get a sense of what to expect with some of the bonds. Credit quality is another thing that you can look at. So if you have a portfolio that tends to have higher credit quality, that means that the odds of the bond issuers are better of being able to pay you back. If you have a fund that has, or bonds that have very low credit ratings, that's going to give you an idea that I'm probably investing in some riskier issuers where the odds of them paying me back are not necessarily as great. So I bring these two kind of points up in light of a couple of the other slides. So interest rates, again, are really important for bonds. The value of bonds is very tightly tied to the direction that interest rates head. So you can see here, long term, we've had this 30-year steady decline in interest rates. You know, for those of you who were around, I guess you could say back in 1981, a 10-year treasury was paying 15.84%. So you could lock your money up for 10 years and get 15.84% a year for the next 10 years, effectively guaranteed. It's almost inconceivable to imagine that right now, but you can kind of see where we are September of 2017, where 10-year treasury is paying 2.33%. So, you know, with that, you're locking your money up for 10 years to get 2.33% a year. If we factor inflation in, that gives us the real yield. That's the gray line. You're really not making very much money on your investment. Where might interest rates be headed? As you can see here, we've seen the steady decline in interest rates. You'll see the graph around 2008 with rates going down, 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 down. And then we have this long stretch with interest rates basically at zero. They've started to climb up. And then, you know, the question is, you know, where are things headed in the future? So the blue dots are basically what the Fed is estimating. This is where they think interest rates are going to be out into the future, 2018, 2019, etc. So, you know, let's call it by 2020, they'd like to see interest rates around 2.69%. Does anybody believe them as to whether interest rates are going to get there? Probably not, because the red dots are what the market's expectations for where interest rates are going to be. So the Fed seems to think they'll be running at 2.69% interest. The market thinks by 2020 we'd only be at about 1.71% interest. So the market is discounting a little bit what the Fed is saying. But either way, interest rates are on the rise. So if rates rise, the question then becomes, all right, what might be the impact on the funds that I own? So this is an interesting slide to look at because what it shows is that not all bonds react the same way to rising interest rates. So if you look at the right-hand side of the chart, you'll note, you know, a 2-year treasury, if interest rates went up 1%, we'd expect about a 1.9% decline in the value of the bond. But if you own a 30-year treasury, a 1% rise in interest rates, you're looking at nearly an 18% decline in the value of the bond. So an 18% loss sounds almost more like a stock than it does a bond. And then you can kind of see everything in between. So there is a wide range of motion, I guess you could say, depending on the types of bonds that you own. Underneath that, you can see different, other than kind of treasuries or US government bonds, different types of bonds, what could be the impact with interest rate movements. And again, you can see there's a wide range, whether that's high yield bonds, whether that's floating rate bonds, whether that's mortgages. Each has their own sort of characteristics. So if we put a little bit of this together and take a look at kind of what we have within the Dassault plan, blending those two concepts together, duration, credit quality, I think what you'll see here is as it sits right now, The Fidelity Strategic Income, that's our multi-sector bond fund, actually has the lowest duration of 4.8 years. So 1% rise in interest rates, we'd expect about a 4.8% decline in the value of the portfolio. The US bond index has longer duration. So again, wider range of movement. And then our TIPS fund actually has the most duration. So that's the longest maturity. You can see to the right as well, the split in credit quality. So the US bond index tends to be very high quality. Strategic Income is much more of a blend. There's some lower quality bonds as part of it. PIMCO, I did not have any credit quality information, so that's why it's blank there. I had an average, but they did not give me the breakdown, I'm afraid. So this might also be kind of a tool that you can use as you assess your portfolio. If you have any of these different bond funds, you can look at some of these numbers to kind of get a sense of what you might expect. Okay, very good. I am at the 3 o'clock mark, so it did actually take me an hour to get through this point, but Colin, maybe what I'll do is open it up for some questions and do my best to answer them.
We've got a few questions out here, and we'll go for a few minutes here while we have the time. The first question is, somebody has been contributing pre-tax dollars to their 401k. Is there any possibility or option to convert any of those funds to Roth 401k?
As it stands right now, there is not. So we don't have an in-plan Roth conversion feature. Potentially that might be something that we look at in the future as something that we could potentially add. It's not there right now, but it is potentially an option that we could include in the plan. The only thing that you have to think a little bit about with that is obviously the tax piece. So if you do convert, then you do trigger the taxes on whatever you convert. So you have to be prepared to have the tax dollars set aside someplace. If you had $100,000 that you converted, and you're in the 25% tax bracket, all right, you're going to trigger a $25,000 tax bill. So you'd need $25,000 sitting around someplace to be able to pay the bill when that comes. But that's definitely something that we could look at.
And I think this one will be an easy one. Is there a limitation as to how many times you can change your portfolio within the DS plan?
No.
To either different or bond. Yeah.
Exactly. So there's not a limitation on that. You can change it every day if you really wanted to. Actually, maybe. I'm sorry. Go ahead.
Oh, go ahead.
I was just going to say, on a quick side note, one of the hot topics that's been in discussion lately has been around tax reform and the impact on 401k plans. We had the president come out, I guess, a week and a half ago saying that they were not going to touch 401k in terms of how much you could put into 401k plans or how much you could deduct from 401k plans. I was just looking at the news today. The Republicans have come out with a tax bill. It does look like that is baked into their bill as it stands right now, that the pre-tax component of 401k would stay intact. There was a lot of debate the last week about whether the pre-tax would go away or would shrink down very substantially there was a number of $2,800 that was floating around out there, and then everything else would be Roth. But at least the reporting this afternoon seems to indicate that the pre-tax piece of 401k is still intact as it sits here right now. I figured I'd just put that out there as that's a timely update.
Right. And do we have any in terms of you're moving your funds around, do any of our funds have any type of short-term trading fee?
They don't. They do not.
Right. Okay. You had talked about the rebalancing, specifically within our 401k plan. If any of our employees have Fidelity for IRAs, et cetera, as well, is there a way that you can rebalance your entire portfolio? Do you know?
I don't think so. I believe the rebalancing function that I described, or the screenshots, affect merely the 401k itself. I don't believe there's a rebalancing function that would incorporate any non-401k assets.
Okay. We actually had a couple of employees ask questions about, in essence, this emerging market of Bitcoins, et cetera. Do you have any thoughts or feedback on that market?
I mean, I know. I'll be honest. I'm not expert in that area by any means. It does appear that is a a burgeoning market of to some degree. You know, the value of Bitcoin has risen pretty substantially since, I want to say, Bitcoin seemed to bottom out. Maybe it was 2015 or so, and has recovered to some degree. But you know, the outlook for, I guess you could call it, alternative currency, I don't know a lot about that.
Sure. Okay. And obviously we don't have that within our 401k plan.
No, certainly not.
I'll try and stick to questions more focused on what we do offer. Is a 401k contribution limited in any way, like the traditional Roth IRA? Contribution limits or any type of limitation on the Roth 401k contributions?
Okay, so the only limits with Roth 401k would be the IRS limit, which says that the most you can put into a 401k plan in 2017 is $18,000. So that would be your cap for Roth 401k. In the Roth IRA world, there are other limits. So for the Roth IRA, there's a $5,500 cap. There's also a catch-up if you're over 50. It lets you put in another $1,000. But then there's also an income phase-out. So for Roth IRA, if you make too much money, you may not be able to make a Roth IRA contribution. Roth 401k, there is no income phase-out. So if I made $10 million a year, I could still put $18,000 into the DS 401k plan on a Roth basis. Those are really kind of the constraints, I guess you could say, from the contribution standpoint of being able to put money into the various accounts.
And I do want to just clarify, one of the employees had come back and is questioning the ability to move funds at any time. It's in essence a daily activity. You can make your changes to your funds in essence every day. Basically, it's selling at the 4 o'clock time frame, Eastern time, daily, and that's what your opportunity is. It's not once a month or based on pay periods or anything like that. It is daily. You can make changes to your investment.
That's correct. Now, keep in mind though, mutual funds only trade once per day. So right. You couldn't, unlike a stock or an ETF or something like that, where you could buy a stock at 10 in the morning and then sell it at noon and then buy it back again at 2 and then sell it again at 4. You can't do that with a mutual fund. Mutual funds only trade a close of business. So at 4 o'clock, whatever the price of that fund is worth at that time, that's what you get. So a little bit of it.
And this is again just a broad question. Does the $18,000 limit, does that include the employer match, or is it just the individual contributions?
That's just the individual contribution. So the match is over and above that 18,000 figure.
Okay. And we have a few questions about ETFs. And first off, are they in our plan, or is there any thought to include them in the future?
They're not in the plan. ETFs have been kind of a struggle with 401k plans. I've yet to come across a 401k plan that trades ETFs. I think for whatever reason, the technology around the trading component with it has been something that the industry has kind of struggled with. Again, because of the intraday trading capability of the ETFs. So I don't anticipate us adding ETFs at this stage. It's not that we're against ETFs or anything like that. It's more of a systems limitation with Fidelity. I don't believe Fidelity has the ability to trade the ETFs as part of a 401k plan. You can certainly trade them in an IRA account, but it's sort of a different system that's used to administer the 401k. That's pretty typical kind of across the board with all the different 401k record keepers. I've yet to come across a plan that is ETF based. Okay. But I'm sure that that day will ultimately come, though. Yeah.
Sure. This question is really, I suppose, more so that everybody has some sort of concept of how do we choose funds, and I say we. Could you explain a little bit about the steering committee and your role and how the funds within our plan are selected?
Sure. So we do have a committee that meets on a quarterly basis to review and sort of discuss the investment options as part of the plan. We've had this committee for 10 plus years, I would say, at this stage. So the committee meets, we have a series of criteria that we lay out for what we expect of each of the different funds inside the plan. So if we have a fund that is not necessarily meeting the either performance expectations or the expense expectations or the risk expectations, then we would look at potential alternatives. So for anybody who's been with DS for a little bit of time, you have likely seen funds come and go. So it does happen that we will, we'll add funds to the plan, we'll delete funds to the plan. Our intention with that is, ideally we want to minimize that as much as possible. I think we don't want to have a situation where we're constantly cycling funds in and out. I think that tends to work against us, quite frankly. But it is, it's definitely, this is not a scenario where nobody is minding the store. It is definitely senior management that's involved in the decision-making process. It's our firm and our research kind of behind us, guiding us around kind of what's happening with each of the different managers, what's happening with the markets, how that interrelates with the funds that we own. So it's sort of a constant dialogue that we have, every 3 months to kind of reassess. Where are we? Are things performing the way that we would hope for? I think the results to a large degree speak for themselves. Certainly not only just this year, as we mentioned, all but 3 are in the top half of their peer group. Many of them are in the top third or the top quartile. But even as we look out on a longer term basis, we only had 2 funds that fell in the bottom half out of 29 or 30 different funds. So I think the process seems to be working.
Sure. And we're going to wrap with this, and really what it is can you really explain how or what access employees have to you and what they can get in terms of working either with you at Gallagher, again, working with Kendall or anyone on the Gallagher team is at no cost to you. It's part of your participation in the DS 401k plan. But Kendall, if you don't mind,
absolutely.
Go into detail in terms of your availability, how often, when employees can contact you, so they're fully aware. And the reason I say this is we have a number of questions that are probably more specific to that individual and their needs. So making sure all of our employees.
Sure. Employees can reach out to us really at any time. You can leave them you can give us a call, you can send us an email. We'll look to schedule maybe 20 or 30 minutes to chat. Typically it's going to be a phone call. A lot of times these days people will use their Skype tool so that we can share screens and look at kind of the same information together. The nature of the conversation is pretty broad. Some people are calling they want to review their portfolio. Do I have the right funds? Do I have the right mix of funds? Am I contributing enough to be on track? Can you explain to me, would I be a good candidate for Roth, or does the pre-tax piece make more sense? Where do you think the markets are headed? How should I position my portfolio accordingly? These are very sort of common questions that we get. And we're more than happy to delve into those. A lot of times people will ask us about, okay, I have some money here in the DS plan, but then I have my old 401k, or I have an IRA. Can you give me your 2 cents on, how those two interrelate, or if you have any suggestions on kind of balancing between those, we can definitely tackle that. Some of the people at the younger end of the equation sometimes will ask about more life events. I'm getting married. What should I be thinking about? I just had a child. What should I be thinking about? We just bought a house. What should I be thinking about? So we'll give you some ideas of kind of best practices from a financial planning standpoint. All those different types of things are kind of out there. What I would say that we don't do is we don't do any individual money management. So if you had an IRA account and you said, hey, Kendall or Adam, can you run this for me? We don't have a wealth management practice, so it's probably not something that we would do. As it relates to kind of insurance or something like that, we'll give you our 2 cents, but we're not really interested in trying to sell anybody any insurance, whether that's life insurance, disability insurance, etc. So, for some of those things, I think we can take things pretty far down the road. If you really wanted, a deep financial plan to look at kind of your tax situation, your estate planning situation, or something like that, we'd probably refer you to a planner. At that stage, you probably want to hire somebody to do the really deep dive. But I would say for probably 85–90% of the kind of questions people have, we're able to handle those.
Great. So we'll wrap up now. I do want to remind everybody that we have recorded this presentation. We will post the recording as well as the slide deck out on the rewards@3ds.com afterwards. And thank you again, Kendall, for your time today.
Thank you. I appreciate it.